Well, what we might do, Alison, is I think we might get started. We don't want to keep people waiting too long today. We've got a few people who've joined us on time, so let's honour their time today. So thank you very much for joining us today for a webinar. Our webinar today is going to be focused on superannuation. Specifically, Alison, my colleague, and I will be talking to you about some of the changes that have occurred in the last 3 or 4 months, and specifically those new rules that are going to be applying from 1 July, which is in a few days' time. The information that we're going to be providing today is general in nature. We haven't taken into account any of your personal circumstances in formulating this advice. So please, before you take action on any of the ideas we present to you today, make sure you get some advice before you act. Before we sort of leap in, yes, and the other thing is that we've got a Q&A button at the bottom of the screen. If you've got any questions, please put them into that question and answer button. We'll endeavour to either answer those along the way, or certainly at the end we've left some time for questions and answers, so we might be able to address them all then. So before we leap into the detail, a lot of these ideas that we're going to be talking about today have had their genesis in the most recent budget in May, or April, where the then federal government announced some fairly significant changes to superannuation, and most of those rule changes were to apply from 1 July. Most of those changes that were released in the budget were legislated prior to the election. There are a couple of more technical issues that didn't make the cut, and so we won't be touching on those today. But certainly everything that we're going to be talking about today has been passed and is going to be occurring. So the first thing is about superannuation guarantee, and of course you would have heard this being talked about on radio if you've been listening to free-to-air radio recently, that the superannuation guarantee rate is rising from 10% to 10.5% from 1 July. This is part of the legislated increases through to 12% by 2025, and so we've got this next step up next financial year. But the other thing that's occurring is that there's the $450 per month threshold over which superannuation guarantee is required to be paid is being abolished, which means that people who earn less than $450 in a month will be required to have superannuation guarantee payments made on their behalf. So for those of you who've got teenage children or grandchildren who are doing part-time work, it won't mean they have to rush out and get a superannuation account just yet, because for those who are under 18, they must work more than 18 hours in a week before the requirement to pay superannuation guarantee kicks in. Related to the superannuation guarantee is single touch payroll, and one of the things that we need to be careful about here as business owners is making sure that our software has been updated to account for those changes to the superannuation guarantee, because as you all know who are in business, your superannuation now has to be paid on a regular basis through single touch payroll, and you will want to be making sure that your systems are calculating not only the correct rate of superannuation guarantee, but also that it's taking into account that the abolishment of that $450 per month threshold. So just something to check with your software providers before you just barrel along into the next financial year. We've got 2 days left. So there's some homework for everyone. Perhaps over to you, Alison, to take on the next topic.
Sure thing. Good morning, everyone. So let's talk about a couple of strategies in relation to the family home. So first one off is the First Homes Saver Scheme. So this initiative was introduced by the government in 2017. Essentially, it enables first home buyers to save for a deposit in super, which effectively this initiative exists to help people save money on tax while saving for that deposit. So under the current rules, you can contribute up to $15,000 per year into super as a non-concessional contribution. And from the 1st of July this year, the maximum withdrawal amount increases from $30,000 to $50,000. So this strategy would be applicable to potentially your children or even your grandchildren that who are looking to enter the property market. The other, I guess, very popular strategy that we're seeing amongst clients is the downsizer contribution. So this was initially introduced back in 2018, where individuals who have turned 65 and over could contribute $300,000 to super using the proceeds from the sale of their home, as long as they meet other eligibility requirements. So from the 1st of July this year, that age is being reduced to 60 years. So making sure that you also meet the other eligibility requirements. So that would be if you've owned your home but between yourself or your partner for more than 10 years, and you've used the property for a period of time as your main residence as well. This downsizing contribution doesn't impact your total super cap. So that means that if you have more than 1.7 million in super, you're still able to contribute via a downsizer contribution. Keeping in mind though, so for those that are between the ages of 60 to 64, you may not have access to capital once you have put those funds into super, unless you've met a condition of release like retirement, for example. Thought I'd run through a very quick case study with you all. So we have here Jill and Jack, 66 and 68. They have sold their family home of 25 years for 1.2 million. And they're looking to buy their next family home, which is a smaller unit worth 600,000. Now, under this scenario, both Jill and Jack can contribute up to $300,000 into super, so in total 600,000, while being able to buy their home as well. So what this means for both Jill and Jack is that they're able to contribute all net proceeds of their home to be able to support their retirement in the future. But one thing that we need to be very mindful is the time frame of which you can put those contributions into super. So the ATO are very strict, so it has to be within 90 days of the settlement date and not the contract date.
Yeah, that's very right. That's very true. So one of the other major changes to superannuation that will apply from 1 July is that the ability for people between the ages of 67 and 75 to contribute to superannuation. Now, currently, this side of 30 June, you cannot contribute to superannuation once you're over 67 and you don't work. So the work test is that you have to work for more than 40 hours in a 30-day consecutive period before you're entitled to contribute to superannuation. And the rules are contained in the superannuation legislation. Those rules have been taken out of the superannuation legislation and put into the Tax Act. And the obligation is on the individual now if they want to contribute beyond 75 to meet that work test. So this applies to all contributions. So your concessional contributions through salary sacrifice, your employer contributions, the superannuation guarantee, but also your non-concessional contributions. The only time that you'll need to meet the work test will be if you're putting personal money into superannuation and you would like to claim a personal tax deduction for that. So it's a personal concessional contribution. Again, those contributions are subject to the $27,500 concessional contribution cap. But to be able to claim those that tax deduction, you actually have to meet the work test. Interestingly enough, there is a little bit of an anomaly there that you could put the money in August but meet the work test in December, which is different to the current rules, which require you to meet the test before you put the money in. So there is a slight change there, but the danger, of course, if you do that, you don't meet the work test later in the year, then you've actually going to potentially have a bit of a problem in relation to that contribution. What we might do, I've got a little example here about perhaps putting that into context of some strategies that might work. Before I launch into this, while you're reading that, I just say that one of the things you can do with the contributions is you can access the bring forward rule. So some of you may have heard this before. For non-concessional contributions, there's an annual cap of $110,000 a year. You can bring forward 2 future years into the current year and put $330,000 into superannuation. Now, clearly, you have to be below the $1.7 million total super balance cap to be able to put those contributions in, but you can actually use that bring forward rule right up to the day you turn 75. So in this particular case, you've got a couple who are 69 and 70. They're retired, taking pensions. They've got kids who are independent, but who will equally benefit from the future estate from their parents, and the parents' superannuation is all taxable component, which means their superannuation has been built up through concessional contributions and earnings. There's been no personal money put in. What it also means is if they were to die today, that there would be tax of 17%, which is 15% plus Medicare, applied to the benefits before they're paid out to their financially independent children, resulting in nearly $290,000 of tax, a reduction in the size of that estate. Now, for these people, if that's something that is of concern to them, there are some strategies they can have a look at. And one strategy is to take money out of superannuation and recontribute it. So for the 69-year-old on the left-hand side, they could take out $330,000 from their super pension today, and in 2 days' time, on Friday, and then recontribute those funds as a non-concessional contribution, and then repeat that process 2 more times throughout until they reach 75. For their partner who's 70, though, because of the timing of when they turn 75, they won't be able to do the 3 lots of $330,000 because they'll run out of time. They'll get to 75 before they can do the 3rd lot. So timing is very important when it comes to looking at these strategies and making sure that you're maximising the amount that you can recontribute prior to reaching that 75 years age. The outcome of this strategy is that all their on the next page, please, Al, that all their benefits become tax-free, and it saves that tax for their beneficiaries. I suppose one of the other things that it does do is that it future-proofs their superannuation arrangements to an extent, because they've moved all their benefits from being taxable benefits to being tax-free. Now, we know that at the moment, retirement pensions are tax-free to recipients, but by recycling these to being tax-free benefits, it certainly does future-proof the super fund from future changes to tax laws, which may occur. If there's one certainty we all know when we deal with those of us who deal with superannuation is that change is a constant. And so we just like to make sure that we can optimise people's arrangements as best as possible. The other key part to this strategy is that it relies on having a pension in place to start with. You take the money out and you put it back in and start a new pension with that recontributed funds, because each pension, when it's started, isolates that money in its separate pension, and it means its tax-free nature is isolated from the taxable nature of the previous pension it came from. It doesn't mix in together, and that's a really important part of the strategy, where you're starting new pensions each time you're putting the money in. The other strategy we could have a look at, which is an extension of that case study, would be if the same couple also had some money outside of superannuation and perhaps one of them was still working. Under that arrangement, they'd have some employer contributions coming into the super fund on a regular basis, but they could also make personal contributions to super and claim a tax deduction for that, to offset some tax either on their earnings or on the investment earnings from the super for the investment portfolio. So they could continue the withdrawal and recontribution strategy, but also this member could also be putting more money into super to claim a personal tax deduction. Of course, the alternative strategy there is just a salary sacrifice from their salary, so that 27,500 a year, inclusive of the employer contributions, is going into the fund. There's no right or wrong on which strategy you use there. It's simply preference and ease of management as to which strategy you use.
So taking a little side step for a second. So from the 1st of April this year, the Family Law Act and the Taxation Administration Act have been amended. So now it allows for the family court to actually have access to certain superannuation information held by the ATO for the sole purpose of family law proceedings. So what this means is that some of the information that is now widely accessible are superannuation balances of certain individuals, could be any accounts that contain a small amount of super or super held by the ATO even, and also unclaimed super as well. So the main reason for this change is largely due to parties not disclosing this kind of information and the family court just not having access to this sort of information from the ATO. So it makes it quite difficult when seeking a financial settlement at the time of a divorce or separation. So this is a very welcome change, as we believe that it could achieve a fairer outcome for those involved.
Yeah, and I think just to add to that, Al, the family courts do have a significant amount of power to look through structures, and so this has been more of a technical issue where the ATO was prevented from sharing information with the Family Court under Privacy Act arrangements, and so it was a case of, the intention is to create a level playing field so that everyone can have access to information and ensure that the negotiations are appropriate. I suppose the year end is coming up. The financial year end is coming up. We've got 2 days left till the 30th of June. And so there are, this time of year is also a time of year where you take stock of your arrangements to make sure you've optimised them. So any contributions that you want to make to superannuation need to be made by Thursday, by close of business on Thursday. They have to be received by the fund. So I'd suggest today would probably be a suitable day to make sure that happens. Interestingly enough, employers can still contribute through to the 30th of June via the ATO Small Business Clearinghouse, keeping in mind, of course, that the members are not going to receive that money until next financial year into their member accounts. There is a mismatch there. The employer gets the tax deduction this year. The members will have it credited to their accounts in the super fund once it hits that super fund. So for those members who are trying to optimise their superannuation arrangements, it is useful knowing how your employer contributes to superannuation. Also, if you've paid some expenses for your superannuation fund throughout the year, you might have paid the accounting bill personally for your super fund. If you don't reimburse that prior to the end of the financial year, that's going to be treated as a deemed contribution. Now, may not be an issue for most people, but if you're ineligible to contribute this year, either because you're over 67, because of course the new rules don't kick in until 3 days time, so you need to make sure the fund has reimbursed those expense payments for you. If the other issue it could raise is if you've already put in your maximum $330,000 non-concessional contribution and you've also paid some expenses on behalf of the fund, those deemed contributions could tip you over into excess contribution territory, and that could cause some issues for you as well. So that's certainly an area that you need to have a look at. And the final thing there is around pension payments. If you're running a retirement phase pension from your super fund, then you do need to make sure the minimum pension has been paid prior to 30 June. It has to be paid in cash. Pensions have to be cash payments. You can't transfer assets out of a super fund and call it a pension payment, and you can't do journal entries in the accounts to say that the pension has been paid. It has to be a cash payment. But with that in mind, the government has also extended the drawdown rate for the pensions. So account-based pensions have legislated minimum drawdown rates, and you can see there on the left-hand side or the middle column of that table the normal drawdown rates. But for the last two financial years and also next financial year, those minimum drawdown rates have been halved by the government. Now, this is quite attractive for clients who perhaps don't need all that full drawdown rate. They can leave more money in superannuation. But even still, you need to make sure that you do meet those minimums. That brings us to the material we've got to present today is fairly brief in terms of its content, because whilst some of those changes have quite a lot of implications for people, there's not a lot of changes that we need to worry about. But I suppose, Alison, I'd be pretty keen to, so if anyone's got any questions, please put your type your questions into the Q&A section and we'll answer them. But whilst we're waiting for people to think of their questions, Alison, I've got perhaps one for you. What sort of strategies are you now looking at with your clients in light of those rule changes that you're looking to implement now over the next 12 months or so?
Probably more so what you mentioned, Chris, the withdrawal recontribution strategy. Obviously, with extending that age, it gives huge opportunity for a lot of our clients to be able to utilise that strategy. And I think also, probably not so much this financial year or next, but even when that minimum pension goes back to the usual rate, we may find ourselves or our clients not needing that additional amount that's required to be taken out of super. So again, with that extending of that age where we can put money back into super, that's probably something that we would be looking at as well. Because what we've done in previous years, previous to the halving of that requirement, we found ourselves with clients that needed to, they didn't need that minimum pension, so we ended up investing in their own name. This could be an opportunity to just to keep it all consolidated and get that recontributed back into super.
Yeah, I agree.
So question for you, I don't think there's been any questions so far. With the changes in contribution ages, for any of our clients or any of our participants on the call today that own businesses, what should they be considering when selling their business? And even for those individuals, as I suppose, who are not at that stage yet where they are looking to sell their business, what are some of the strategies that they should keep in mind as business owners?
Yeah, great question. And I think that's where, the timing comes into it. So for small business owners, one of the things that often occurs is that you put a lot of effort into running your business and less effort into and building up the value of your own business, but less effort into perhaps investing external to your business. And so often you see a smaller superannuation balance as an end result there. So the small business capital gains tax rules were brought in to assist business owners to move money from the sale of their business in a tax-effective manner across into their superannuation. There's quite a significant tax benefit if you can access those discounts. The timing becomes very important. So you still have your small business capital gains tax money moving across into super fund happens out external to the contribution caps. But if you also wanted to couple putting money in from a sale of business with, say, non-concessional contributions, when the timing of when you make those contributions become very important. For example, if you put money in, today from the sale of a business to your super fund, and with the intention of putting some more money in next financial year through non-concessional contributions, you may find yourself in a situation where you've exceeded the total super balance and can't make that contribution, because the balance that we're using to measure eligibility to contribute is your balance at the end of the previous financial year. So if we're contributing today, we're looking at what was your balance at 30 June 21. But if you're contributing in 3 days' time, you're actually looking at your balance at 30 June 22. So you actually need to look at what order should you be making your contributions to ensure you get the maximum amount in superannuation. Similarly, for people who are perhaps not at retirement age, but perhaps haven't been maximising their concessional contributions throughout their last couple of financial years, you have the ability to carry forward those unused concessional contributions. So just as a reminder, you've got a cap of $27,500 that you can put into superannuation as a concessional contribution. But if you don't use that cap, that full amount, since 2018, July 2018, you've been able to carry forward that unused amount. And you can carry forward those unused concessional contributions for up to 5 years, which is a really attractive proposition. So for someone who's selling an investment property, for example, you might say, well, look, I haven't utilised my concessional contributions. I've sold my investment property. I've got a large taxable capital gain. I can use some of those unused concessional contributions and carry them forward and make a large concessional contribution to offset the capital gain on the sale of my property. So that's a way in which you can use those carry forward contributions. Again, timing's very, very important, because you can only carry forward your concessional contributions if your superannuation balance is under $500,000, and that measurement is done at the prior financial year. So if you if your balance was over $500,000, you've lost that ability to carry forward contributions. Now, the share market falling over the last 6 months may actually help people in that respect, because you might have been just over $500,000 in 30 June 21, but you might be just under $500,000 in June 22, and that might actually provide you with an opportunity to re-look at that strategy. In essence, there's a lot of with all of these strategies, there's a lot of detail. For the small business capital gains tax relief, you really do need to be talking to your accountant about your eligibility to access that regime, because it is a very complex area. Similarly, with your contributions and starting pensions and withdrawal and recontribution strategies, there's paperwork that has to be completed. There's also lodgements that have to be made to the tax office by your accountant, sometimes quarterly, depending on the size of your super fund. So you do need to be aware of the detail to make sure that the strategies you're putting in place actually work. It doesn't look like we've got too many more questions. So, Alison, did you have any other points that you wanted to raise in relation to the new rules and the strategies that we've talked about today?
No, I think we've covered it pretty high level. I mean, of course, if anyone has any questions, please, even after today, just send us an email and we'll be able to get back to you.
Absolutely. What will happen is when you click off the webinar today, we've been assured that this will work perfectly, that you'll actually get a link in your browser for a post-webinar survey, and we'd really appreciate your feedback so that we can make sure that future webinars are targeted to topics that are of interest to you. So thank you again for your time this morning. We really appreciate you joining us and hearing a little bit more about the changes coming in to superannuation. And if you've got any other questions, feel free to email either Alison or myself, and we can certainly respond accordingly. Have a great rest of the week. Enjoy the last 2 days of the financial year, and all the best for the next financial year. Thanks very much.
Thanks, everyone.